everybody, it's Kevin and Pat from NorthStarBadCharts.com, and we want to take a look at what is going on with currencies and precious metals at the moment, in particular the US dollar, and what's affecting the precious metals markets. So Patrick's got on screen here a chart for spot gold, and you can see very clearly the decline into the low point in 2016, and that arc formation that took us all the way back up to the previous all-time highs in 2020, and the smaller arc that's been forming since then that took us back to the to those sort of all-time highs. So what's going on? What's going on? Why is gold being stubbornly resilient at these sort of levels? You can see it's building out a consolidation pattern there over the last 18 months or more. And the US dollar index, as everybody knows, over the last few months has been rising and rising and rising. It's gone from somewhere around about 91 or 92 up to 103. I think we're at 102.9, that kind of level.
All right. Yeah. Well,
so Pat, why isn't gold dropping like a rock? Take it away.
So, okay, so this boogeyman called the DXY there, guys. We have to kill this beast there. So what I do in TA, I looked at, okay, where the price action, here's the DXY, we're above it, above this line, right? But I'm just trying to see backwards in the past. If I would have put maybe the DXY on the candlestick, I put the DXY on candles so you could see the peaks. Line, hollow candles, there you go. We're pretty much all the way up here. So what you do in TA, you see what was happening to the price action previously. So back here in 99, look at gold, guys. It was bottoming. It was down here, right? DXY shoots up, gold refuses to make a new low, bullish divergence, and then it shoots up. And then whatever the DXY does, unwinds, whatever type of fuel it adds, gold goes up. Now let's forward to look at that same level in 2017 for the DXY. Gold, if you keep thinking that gold tracks inversely, then by that measure, you should have said, well, gold should be back down to 300, right, Kevin, or something like that.
Put a little circle on the gold chart just to highlight every time the DXY.
Look at that. Look how much higher, guys.
So put a little circle on there and just highlight each of those points on the gold chart when DXY was at 103, and we'll see what's been going on. There's actually a little circle tool on there, Pat, you can use as well instead of using the
oval, the misshaped circle.
The misshaped circle. There's actually a circle tool on there which I've started.
I know, right here. I don't use it because I have to. There it is. There you go, guys. They just added that on TV. So every single time, here's one. Here's the other one, gold much higher. DXY goes down, DXY goes back up, shoots up. Gold, oh, that's my cert. Gold is higher. DXY so resets.
At the same value, at 103 DXY, gold has gone from a low point there about $300. Then it's gone up to what is it, $1,000, $1,050, $1,100, and then more recently at DXY 103, gold has been around about $1,500, and now at the same value on the dollar index, gold is above $1,700, well, above $1,800.
Right.
So this idea that gold tracks the US dollar index is wrong. And
exactly. So yeah, there's another invisible boogeyman. There's another moving part, guys, in here, which we're going to show you, that is driving gold more tightly. So,
yeah. So gold's moving up not because of the US dollar index, but because of something else.
Yeah. So what is it, guys? What is it? Who can guess? All right. So now what we're going to do.
Well, if gold is getting more expensive and houses are getting more expensive and food is getting more expensive, what's the reason that all of that's getting more expensive? And it's inflation, of course. So the hidden behind all of this, got inflation, and Pat's putting on here DXY, which is adjusted for the producer price index. The producer price index is a proxy for inflation. So that gives a completely different look to it. I think you can agree.
That's right.
There. Yeah.
So let's say at this moment, when the DXY was hitting 103, guys. Here at inflation adjusted, the DXY inflation adjusted was up here. Gold was down here. Now let's see what happens. The inflation adjusted DXY is lower. Gold is higher. Inflation adjusted DXY is slightly lower. Gold is slightly higher. And then adjusted inflation DXY makes a new low. What does gold do? A new high. So this chart tracks a lot better. I'll remove the stock. It tracks a lot better. And look, I'll just invert the DXY chart just to show you how well it tracks. And look at that. Look at that, guys. This is a much better indication of what gold mirrors or reacts to. Or you could say that it could be the opposite. It could be that it's the inflation adjusted US dollar that's reacting to gold. And that you could probably see it because I've done this exercise a few times. I always want to try to find out which one, who's leading who, right? And by doing that, what you have to do is look at important, hey, where's my, okay, here it is, lines. You have to look at when important breakouts happen. Let's say, so for gold, here in the June of 2019, I'll put in but here. So that's when gold exploded. This is the inversed. Should I put it back on the not inversed so people don't get confused, or
maybe.
Okay, I'll put it like that.
People are more used to seeing it that way up, I think.
I'll put that. Okay, I'll put it back hollow candles. And you see here gold broke up, but look at that. The inflation adjusted DXY was still going up. Gold is sensing that whatever move is going up here, it doesn't trust it. And what happens? We're creating bearish divergence. The DXY inflation adjusted keeps going up, but gold's telling you, I don't believe it, guys. And what happens? It cannot make a new high. And when it do, it tumbles. Gold's actually, I don't know, I think it was like 3, 4, 6 months ahead of time. Let me put it here. I'm going to measure that all the way to the peak. 10 months ahead of time, it was telling you that the inflation would ramp up and it would kill the US dollar. It would bring it down inflation adjusted. So that's where we are today. I think I could do another example, Kevin, when this happened. I think back even here in the breakout of 2000, here we had important breakout for gold. Ooh, same time. Right here. Was that the breakout? And here is the breakdown line for, depends how we draw the lines, right? Where's the gold here gave you a few months leadway before the inflation adjusted DXY, before it really broke down from this meaningful 1, 2, 3, 4. Before this broke down, gold was actually already breaking out above its wake up line, its horizontal breakout line. I think even here is one right here. It was already sniffing out a few months ahead that the inflation would ramp up, bringing down the DXY, no matter nominally how the DXY was going up.
I think, you know, the takeaway from all of this that I want people to fix in their minds is that gold is the perfect barometer of the loss of your purchasing power. DXY isn't. DXY is just a comparison of the US dollar to primarily the euro, also the British pound, the Japanese yen, and a few others. So all you're doing with the DXY, the dollar index, is comparing one devaluing currency with a range of other devaluing currencies. The fact that they're all devaluing should tell you something. You're comparing, you know, toilet paper with toilet paper, you know, for want of a better phrase. And you know, the giveaway that is the case is gold, and gold is reflecting the fact that DXY, regardless if the dollar index goes up because of relative strength by the US dollar, regardless of that, if inflation is this big overwhelming tsunami that is eating up your fiat currency, then you know what DXY is doing is almost irrelevant. it's not quite irrelevant, because a lot of people pay a lot of attention to it wrongly, in my view, and so it affects, you know, a lot of trading decisions. And I'm sure that, you know, if and when DXY turns down sharply, gold will get an added boost, because that's just the way people think. But in reality, gold isn't rising and falling because of DXY. Gold is rising and falling because of the inflation adjusted DXY, or the inflation adjusted dollar, in fact.
Exactly. And that, another word for that is your purchasing power.
Yeah.
Look, gold, when it broke down here.
I mean, some people have said actually on social media, and I should address this, that DXY, inflation adjusting DXY, is perhaps not quite right, because DXY is just comparing one currency to another. And, you know, it doesn't actually make any difference whether you inflation adjust DXY or you inflation adjust the US dollar. If you inflation adjust the US dollar, then this is even more crazy, because we all know which direction the US dollar has been going in relation to inflation. You know, down and down and down. And you don't need me to tell you that the US dollar has lost something like 95% of its purchasing power over time. So, you know, and gold has done the opposite. You know, gold has been going from the bottom left to the top right of the chart, and the US dollar has been going from the top left to the bottom right. So, you know, it's just getting into that mindset and viewing gold as the constant, and the US dollar and currencies as the constantly eroding paper currencies that they are.
Exactly. And yeah, just these charts, guys, because they track very nicely inversely. You can deduce that statement that Kevin said, that it's the US dollar inflation adjusted is the gold chart inversely. It is. Like in the arbitrage plays, is like, here gold again, here broke down, but the inflation adjusted DXY, your purchasing power, is still twinning down, but that was 15 months ahead. Gold was already sniffing out at whatever macro tidal waves, capital flows, whatever was happening, that eventually the inflation rate would probably alleviate, or a combination of inflation rate and US dollar appreciation. And look at that.
Exactly. And thinking about it a bit more, actually, you know, when we're inflation adjusting the DXY, what we're actually doing is inflation adjusting dollar strength, because the DXY is a reflection of dollar strength. If DXY is 80, or if it's 100, the difference between 80 and 100 is in the strength of the US dollar vis-a-vis the other currencies. So what we're actually doing here is inflation adjusting dollar strength, rather than inflation adjusting a basket of currencies. So that's one way of looking at it. The dollar strength is being compared to inflation here, and when dollar strength makes breakouts or breakdowns versus inflation, then that's telling you something very important in terms of what gold is going to be doing. And as you can see, DXY adjusted for inflation has made a breakdown. It's just coming back for a little back test, and in the meantime, gold has broken out to the upside and is also coming back for a back test. So the ultimate resolution, Pat's put the arrows on there, and that's what you should expect.
And exactly. So gold leads, but if there's a chart pattern that's actually broken down, and we're starting, you know, there's embryonic patterns, right, where it's a slanted trend line, it breaks down. It's not the final breakdown where it's horizontal, but it adds the confidence that we'll start breaking down more and more, and eventually we're gonna have your purchasing power, we're gonna have a horizontal breakdown line. Like, we're probably gonna close below this line here, this line, and once we close below that, then that's a huge, I don't know, head and shoulders, whatever you want to call it, a huge measured move downwards. So just like, at the end of the day, you can do just classical chart trading on the gold chart, because it leads. So you could look at the DXY, but that's probably going to be in hindsight, as this has shown that gold will break down before this chart breaks out, and gold will break out before that chart breaks down. But as long as this is the gold is above that inclining 3-year moving average, and it already broke out, guys, 3 months ago. So if you, on the monthly close basis, it's already broken down out of the wake up line. Now it's bull flagging above a rising trend line, a 3-year moving average, until it does something like it did here in 2013. Then you have to put the odds are that this will continue upwards, and we're going to have a surprise here with even more inflation and or a crumbling US dollar, guys. Because remember, it's a ratio chart, the purchasing power. The DXY could go up versus the euro, but if there's so much inflation, even if the DXY is at 150, 200, 500, there's so much more inflation that your purchasing power could still be going down the drain.
And the backdrop to all of this is, some pretty scary stuff that's going on at the moment. The 10-year yield is at a critical level. Inflation is breaking out. We're in conditions that are eerily similar to the 1970s in terms of yields going up, real yields going down, inflation going up. There's a lot of echoes of the past there, and of course the elephant in the room is the size of the debt, and the US's ability or otherwise to service that debt as and when interest rates rise. So that's a big elephant in the room here. So we could be looking at the 1970s on kind of steroids, but all we need to focus on here, in this particular podcast is what gold is telling us. And gold is a barometer. I've said it before. It's telling us about the health of the overall economy at the moment. Sometimes, gold going up is not too much of a big deal as far as the economy is concerned. Doesn't necessarily mean anything terrible is happening. But in this particular instance, I think the outcome and the upward moves in precious metals coming in the next few years are going to be set against a backdrop of some pretty historical events, and I think people will look back at these in years to come and study them, much as we do with the 1970s.
Captivating stuff, man. Follow the gold chart, guys. It's the center of the universe. Forget the noise. Follow the gold chart. It'll tell you where capital flows are going, where you should be allocating your stuff. It's the gateway for everything. Commodity complex, US equities. It's look, I think it's the most important chart in the entire financial world there.
Yeah, use it to your advantage. It's giving you really useful information.
I don't get it. It's just a rock, Kevin. Why are we paying attention to a rock? What's wrong with us?
It's a useful rock. I love it.
All right. Thanks, guys. Thanks for watching.
Cheers, everybody. Bye for now.